Okay, so now that we have all of that information, how does it all work together? So we have revenue minus the cost of goods sold gives you a gross profit. If you take that gross profit divided by the revenue, it gives you your profit margin. And we have our fixed expenses, which gives you our EBITDA. And then you have taxes, and minusing those will give you your net profit. That is called your profit and loss statement. Knowing those numbers will help you determine whether your business actually qualifies from a financial standpoint to actually continue being in business, if you have potential in your business or not. From the numbers standpoint, not the market segment, not scalability, not your gut, just profitability. So what is break-even point? And why, if we already have all of these numbers, why is it important? And let me start with the definition of break-even. So the definition of the break-even point is how much revenue you need to sell in order to break even. In other words, cover all of your fixed expenses plus your cost of goods sold. And the reason I'm going over all of this is because a lot of business owners that I come across think that revenue correlates perfectly with their expenses, and break-even point is to show that it does not. And we'll go into that. So the calculation to determine break-even point is you take your fixed expenses divided by your gross profit margin. Don't worry if this is confusing right now. We'll do a few examples of this one because this is a really, really important calculation to know and understand. So let's do one example. Let's say that a business has fixed expenses of $15,000 and a gross margin of 30%. The question is, what is my break-even point? Meaning, how much revenue do I actually need to sell in order to cover my fixed expenses of $15,000? So what you're going to do is you're going to take the $15,000, which is your fixed expenses. You're going to divide it by 30% or 0.3, which is your gross profit margin. And it's going to give you a value of $50,000. That means that in order to pay your fixed expenses of $15,000, you don't need to go sell $15,000 of product. You need to go sell $50,000 of product or service in order to cover that $15,000 gap. You see how a lot of business owners think that going and selling $15,000 more in revenue will solve the issue, and how that actually gets them in trouble a lot of the time. I see this happen all the time. They sign up for a $1,000 a month subscription and they're like, oh, sweet, I can easily go get an extra $1,000 in revenue. Wrong. This is really important calculation to determine if you are going to take on an extra $1,000 fixed expense, how much extra revenue do you actually need to get in order to pay for that each month? All right, let me read through this, make sure I covered all this. Okay, yep, covered that. So any additional, okay, this is important. So any additional revenue sold will add profit to the bottom line equal to the gross margin. So let's do another example with this. Let's say that we know that $50,000 is their break even. That's going to cover the cost of making the product and the cost of all the fixed expenses. They haven't made any money yet. Let's say they go out and they make another $10,000 in revenues for a total of $60,000. So we know that the first $50,000 just adds to the break even. So what's left over, $10,000, is not profit, but 30% of that will be profit because all of the fixed expenses are taken care of. Now we can actually take the 30% and actually put it to the bottom line. So what we're going to do, we're going to do 10,000 times 0.3. That'll give us, well, I guess I could have done that in my head, but calculators make it so I don't use my head anymore. $3,000 in profit will be added to the bottom line, which means if this business in this scenario goes out and does $60,000 in a month, that means that $3,000 of that $60,000 is what the business actually gets to keep. You see how this becomes valuable. But in order to know how to do these break-even equations, you need to know what the difference is between your fixed expenses, cost of goods sold. You need to know what your gross profit margin is. You can't do these calculations unless you know that data. Let's do a couple more examples. And I kind of covered like the break-even magic because This is worth actually me reading. So many business owners incorrectly assume that if they want to make more money, they need to increase their revenue proportionally. This math shows that it is not, almost never, a 1-to-1 ratio, and it'll help you determine the amount of revenue you need to meet your profitability goals. So let's do another example. A business loses $5,000 in a month. What this means is that it's incorrect to think that they just need to go get another $5,000 in revenue. So with the following assumptions, if the gross profit margin for this business is 70%, the question is, how much revenue do they actually need to go do to not lose a $5,000 the next month? Assuming, okay, here's another assumption. Assuming that that $5,000 was a one-off thing, assuming that this is like a regular recurring loss. So if the profit margin is 70%, it means that we need to, let's do the math first. So we're going to take $5,000. That's the loss. That's the money we need to recoup. We're going to divide that by the gross profit margin, which is 70%. And that gives us a value of $7,142.86. So we don't need to go get another $5,000 in revenue. We need to go get another $7,100 in revenue to make up that $5,000 loss. Let's do another example. So in this example, a business wants to hire another employee at a salary of $70,000. And again, I see this a lot. People think, oh, yeah, if I hire this person for $70,000, then I can definitely go get another $70,000 in revenue. Or what I hear is, yeah, we have $70,000 in profit. We can afford this. Yeah, that's like super dangerous. Make sure you use this break-even point magical formula to determine whether or not you can actually afford the $70,000 employee. So let's do the math here. If the gross profit margin for this business is 40%, what we're going to do is we're going to take the salary, the fixed expense, $70,000. We're going to divide it by 40%. It's going to give us $175,000, which means that we need to collect $175,000 in revenue just to pay for the $70,000 employee. I'm going to read this last section too. So the break-even math can be used in countless scenarios to help you correlate revenue with profit and make sound business decisions, not do I have enough money in the bank account type decisions. Because how many of you have done that? Like for reals, you have an app on your phone or you open up your computer, you open up your bank account. Okay, I have enough money. I can afford this one time, or I can afford this on a recurring level. I'm telling you now that you need to stop doing that. That is not a good way to run your business. You have to use this formula when you start making those type of fixed expense decisions. So in order to do so, you have to know your margin. Gross profit margin. So of all of these, this gross profit margin is debated as the most valuable financial metric to know and understand in business, because so many decisions are based on that percentage value. That doesn't mean it's the only one to know. It's just debated as probably the most important. It's obviously really the most important one is your business actually making money, the net profit, right? But if that's the only number you look at is net profit, then and you're negative, or you're not, or you have like a 4% net profit margin, it's hard to know where you can make improvements in your business. Most of the improvements can be made on knowing your gross profit margin, because knowing your gross profit margin and then knowing your net profit will automatically tell you what your fixed expense ratio is, and you can start dwindling, like you can start like knocking some of those things out, or making that margin lower. You can start making improvements on fulfilling your product or service to make that cheaper. You know, whether you need to raise prices for your customers. A lot of those decisions can't actually be answered unless you know your gross profit margin.